Hello, everyone. This is Mark with Semantics Trading with your daily report. So we saw the markets push higher today, and VIX fall for the 20th session in a row. We did have recession fears being prevalent as defensive led the day, while energy was the weakest sector. We did see information tech being bought overall for the third straight day with a Z score of zero point 0.9, being driven by massive short covering. Going into tomorrow, we do have very key earnings before the bell, which is Walmart and Target, which will be very key on telling us how the consumers are holding up. We do also have options expiration this week, which hedging flows can affect prices, and there is a lot of positive delta out there. So if we de-risk, that can open up volatility expansion going into expiration. And we also have the FOMC minutes and the retail sales, which are very key risk events. And that will be on Wednesday. So we are approaching midterm elections, which at this time of the year will have a significant influence on the markets. If we do see a divided government where nothing will be done, then the Fed will be the only game in town and will be the only player that could do fiscal policy. So perhaps that is the reason why the market is thinking the Fed will do rate cuts next year, despite the Fed stating that they will do cuts in 2024. We do see a bit of inversion on the curve, but not by much today. It's quite interesting as the Fed minutes are coming out this Wednesday, which will likely be hawkish, and the Fed has no reason to be less aggressive with inflation being high. And what I think is that the Fed wants to avoid making the same mistake as Arthur Burns' Fed in the 70s, which what happened was they raised rates but then pivoted way too early, which made inflation persistent for the whole decade. But we do have to consider that our economy was significantly different from the past. In the 1970s era, recession would be more systemic and would wreck entire industries, meaning that it would take a long time to recover, or if it usually didn't recover and it just laid waste to the entire industry, and jobs would just be would disappear, and there'll be a massive supply of the people who needed jobs. But looking at our economy now, we are way stronger than back then. We do have some parallels with the 1970s in terms of inflation, but it is hard to say that it is the same situation. Also back then, they were dealing with U.S. auto and steel being laid to waste by opening up exports in order to support allied nations, as their currency actually made U.S. products less competitive to their products, and as a result, we saw U.S. industries be laid to waste. And we also did see major smog and pollution issues at the time, which made cleanup costs very expensive, and that dug into the economy as well. The reason why we look at the bond market is that the bond market is also a live, real-time projection of what the market thinks the economy is headed towards in the future. So if we do invert, that does mean that the shorter-term rates go higher than the longer-term rates, which tends to mean that the market thinks the economy will worsen and demand higher yield for their investment in bonds because of the risk. If the market thinks that are going to into a strong recovery, you tend to see a large steepening of the curve where the longer term rates go higher than the shorter term rates, and spread between them widens significantly. So the wider the spread is better in terms of expectations of future growth. And the yields going up and down does affect stock valuation, as if the yield goes down, it does lower the risk-free rate, which is used to discount the value of a company, but it can't hurt a valuation of a stock, as growth fears can hurt the projected future cash flow of the company, which also affects valuation, of course. We are also seeing the Fed funds futures project a pause and rate cuts into early next year, basically to figure out the projected Fed funds futures rate. You just go with the month, and you get the price of the futures contract and subtract it from 100. Basically, 100 minus the Fed funds futures price is expected Fed rate. So thinking ahead, I do think that several things would need to be seen in order to contribute to a stronger support to sustain the market. That would be lower inflation print, which of course can be done with seeing the rental market go down, which is a significant driver of core CPI, as well as services. We could also see human participation, which could be very pivotal, as if people were to close their short positions, start buying, and start levering up, that will add more conviction in the market, as well as a dovish inflection from the Fed, which I don't really see in the near term. And this is quite a tall order, but yeah. Going into Jackson Hole as well, towards the end of the month, we do expect the liquidity to worsen as we head into it. And at the current moment, we do see mutual funds still sitting on large piles of cash. We do see hedge funds are regrossing. Actually, Goldman Sachs reported that the largest buying was from hedge funds in more than 3 months ago. And as well as we do see some retail participation in meme stocks, as well as volatility control funds, which have increased equity exposure from 37% in June to 54%. And we do see risk parity funds are still running low equity exposure at the moment. And so overall, I would say we are still quite low in terms of positioning, but we are getting less underweight. At the current moment, we do see some hesitation due to macro and geopolitical risks, as well as recession fears, which are quite prevalent. And that is that for today's report. I want to thank you all for watching. This is Spectre Trader signing out.